Nearly 1,000 years ago, long before stock markets, long before central banks, a scholar in the medieval Islamic world issued a warning. Al-Ghazali argued that money was not wealth itself. It was a tool, a mirror, a moral instrument. When money lost its ethical boundaries, he warned, societies would decay from within. At the time, gold and silver constrained rulers. Coins required metal. Metal required limits. Fast forward to today. Money is no longer metal. It is policy. It is created, expanded, contracted, not in minds, but in meeting rooms. And at the center of that power stand, institutions most people barely understand, central banks. They are described as guardians of stability, protectors of the economy, technocratic institutions above politics. But history tells a more complex story. To understand who central banks really serve, we must go back to their birth, the birth of modern central banking. In 1694, England was at war and nearly bankrupt. The Crown needed money urgently, so it partnered with private financiers and created the Bank of England. In exchange for lending money to the government, the bank received extraordinary privileges, including the power to issue notes. This was revolutionary. For the first time, a permanent institution stood between government debt and public trust. Central banking was not born to protect ordinary citizens. It was born to finance the state. Over time, its role evolved, but its DNA remained intertwined with government debt, crisis, and reinvention. The United States followed a different path: chaotic banking, frequent panics, no lasting central authority. Until 1913. After repeated financial crises, the U.S. established the Federal Reserve. The mission was clear: prevent panic, stabilize credit, act as lender of last resort. But history would test this mission brutally. In 1929, markets collapsed. What followed was the Great Depression, the most devastating economic contraction of the modern era. Banks failed, unemployment soared, global trade imploded. The Federal Reserve's inaction during key moments is still debated by historians. But one lesson was burned into institutional memory: never allow systemic collapse again. From that moment forward, central banks became more interventionist, more aggressive, more powerful, the end of gold and the rise of pure policy. For centuries, gold acted as a discipline mechanism. Governments could not expand money infinitely because gold reserves were finite. That discipline ended in stages. The final break came in 1971, when the United States suspended the dollar's convertibility into gold. The gold standard effectively died. Money became fully fiat, backed not by metal, but by credibility. From that point forward, central banks no longer managed gold flows. They managed expectations. Inflation targets replaced metal reserves. Interest rates replaced physical constraint. And with that shift, power expanded dramatically. Stability above all. Modern central banks define their mission narrowly: price stability, maximum employment, financial stability. Notice what is absent: wealth distribution, moral philosophy, structural inequality. When crisis hits, central banks move fast, not to equalize society, but to prevent collapse. In 2008, when global finance nearly froze, liquidity flooded the system. Interest rates fell to near zero. Balance sheets expanded massively. Markets stabilized. But asset prices also surged in the years that followed. Those who owned financial assets benefited first. This was not necessarily favoritism. It was transmission mechanics. Central banks stabilize through financial channels, and financial channels are not evenly distributed. Governments and central banks, a delicate dance. Historically, central banks financed stability during war and crisis. Today, they also influence sovereign borrowing costs. When governments run deficits, central banks can purchase government bonds. This keeps yields lower than they might otherwise be. Officially, central banks are independent. Functionally, they are deeply intertwined with fiscal policy. If debt grows too large and interest rates rise too quickly, governments feel pressure. So, central banks walk a tightrope. Tighten too much, recession. Ease too much, inflation. The balance is fragile, and credibility is everything. Because without gold, without metal, without physical constraint, trust is the only anchor. Who do they really serve? History reveals a pattern. Central banks were created to stabilize state finance. They evolved to stabilize banking systems. They now stabilize global capital markets. Does that indirectly help citizens? Often, yes. A collapsed banking system devastates everyone. But their first instinct is systemic preservation, not moral calibration. If Al-Ghazali evaluated modern monetary policy, he might ask, does this system serve society, or does society now serve the system? That is not a rhetorical flourish. It is a structural question. Because central banks are not designed to solve inequality, they are designed to prevent breakdown. And survival has its own hierarchy. Liquidity flows first where leverage concentrates. Stability is restored first where systemic risk resides. Household pain moves slower. Market panic moves instantly. Institutions respond to speed, the deeper pattern. Across centuries, one theme repeats. Financial systems justify expansion in the name of stability. From 1694 to 1913 to 1971 to today, each crisis increased central authority. Each collapse expanded intervention. Each rescue reinforced dependence. This does not make central bankers villains. It makes them custodians of a highly leveraged architecture. But architecture shapes outcomes. When stability becomes the supreme objective, other values adjust around it. Equality becomes secondary. Moral philosophy becomes academic. Efficiency dominates ethics. And yet, without central banks, modern economies might fracture quickly. So the question is not whether they are necessary. The real question is, can a system built purely on credibility sustain trust indefinitely? History suggests that monetary systems endure only as long as confidence does. Gold required mining. Fiat requires belief, and belief is fragile. Understanding central banks historically changes how we interpret their actions today. They are not neutral referees of fairness. They are guardians of continuity. The system survives. The structure persists. The incentives remain. And history quietly keeps repeating. If you want historical analysis that goes deeper than headlines, subscribe. This channel is about power, money, and the structures that shape history.